We always start our call by summarizing how we ended the previous call. So we started off with we ended the last quarter call with 5 salient features, as I call it. The first aspect being the portfolio health has been at its best shape since inception. And in this call, I'll define what that means. A lot of things have happened from a global market perspective in the last 2 years, be it in terms of COVID, the risk of war, resulting in supply chain disruptions. And these have actually benefited the health of our portfolio. And again, I'll define what that means and how we measure this. We continue to believe India being the best geography for risk deployment today. And I'll highlight why I maintain this stance as we speak. Bottom-up stock picking will continue to be the biggest driver of portfolio returns. And we also ended the call by saying the risk of inflation does not look as though it's transitory. And today the world seems to be acknowledging that and pricing risk accordingly from where we stand today. Right? So coming back into what we did in the quarter, some of the new positions that we actually took into the portfolio as we speak. We bought Balkrishna Industries back into the portfolio. This has been a stock that we owned in 2017 and 18 and 19. And currently with the auto cycle, as well as the fact that Balkrishna Industries is the market leader at a global level, and the fact that competition is being taken out because of pricing pressure, and because Balkrishna Industries EBITDA margin is almost close to 3x the next competitor globally. They have a robust expansion plan set. The fact that they backward integrated into carbon black, which is their raw material, is benefiting them, as a result of which we believe that the valuation is still reasonable, and we expect a good growth on the company over the next 2 to 4 years. Diagnostics, we took a starter position in Dr. Lal Path Labs, which is the market leader. Obviously, diagnostics as an industry has been hurt over the last 6 to 8 months. Every company in the space, in the listed space, is down almost 50 to 60%. There is a reason for that, because the market gave a multiple to these businesses on COVID plus revenues. And when that COVID plus revenue started going to zero, then the market realized that they had repriced these companies fairly aggressively. So most of the stocks are down 50 to 60%. And I would think, I would not want to compare the revenues or the price action 6 months back to today, because I still believe that the price action 6 months back didn't make much sense. The question is, now that the prices have corrected, is there margin of safety? For which there is another risk that is impending in the market, which is e-commerce players like PharmEC and 1MG and the new, or even some of the pharma companies entering into the diagnostic space and creating a lot of significant pricing pressure. If you look at open newspapers today, there is advertisements running on the front page for a checkup run at 100 rupees. It used to be 700 rupees, saying that there's an 80% discount. Our view on that is diagnostics being, if you think about it yourself, you go to a diagnostics lab for 2 reasons: for the quality of the test, and maybe you go twice a year, right? So this is not an industry that works on discounting. Very similar. When you buy food online or delivery online, you might look for the cheapest prices. But when it's a diagnostics lab that you're talking about, it's not purely on the fact of who offers the cheapest price, because service matters, localization matters, being close to your home matters. So while there is near-term pressure, we certainly believe that the market leaders who have protected their margins for the last 12 years are the best equipped to handle this. And hence, we own Dr. Lal Path Labs here. And the last company is a micro-cap company called RACL Geartech. Very interesting company. It's an extremely small market cap oriented company. Market cap would be 600 crores. This is the only gear company in India which continues to have an EBIT margin of north of 20%. This is unheard of for a gear company. The reason primarily being they are a niche gear manufacturing company, supplying to the likes of BMW, Porsche, Volvo, in the two-wheeler segment, in the four-wheeler segment, Kubota, which is a Japanese tractor manufacturing company. And they are also now going into EV. They have the ability to actually manufacture. Just because there is a transition into EV doesn't mean you stop using gears. In fact, it's quite the contrary, where the torque as well as the precision requirement for EV is that much higher. So it's not like a traditional gear manufacturing company can transition into EV. In fact, if you look back, many people may have forgotten this, but the first EV manufacturer in India was a company called Reva back in 2010. Right, Reva didn't take off because that was too early for India to transition into EV, and I still think it is even today. But my view aside, the gear manufacturing for Reva back then happened to be RACL Geartech. So it's a small niche manufacturing company with good margins and a quality promoter. There is a risk, like any micro cap, there is a risk because a lot of the expansions being done today is being funded through debt. However, the expansions are being done on the back of a strong order book. So unless and until we go through a sustained recession where the order book contracts, that risk on the balance sheet is not material. And being a micro cap as well, we've obviously managed the risk through the position sizing that we would own in such a company as well. Moving on from a strategy and a portfolio construct perspective, we continue to maintain a non-model portfolio that will not change. What that means is you would find healthy cash balances across all our portfolios. In fact, many of our clients and many of our partners, our business development team would be talking to them on a regular basis around adding cash into the portfolio today. And we continue to be extremely selective in deploying capital on a bottoms up stocks selection basis. If you look at the portfolio, you will find a common theme. The common theme in our portfolio is owning businesses which have pricing power. Now, why does this matter? If you had read the letter that was sent across to you, we would have spoken about in the last 1.5 years, how has the gross margin of our portfolio expanded by 4.5%? Now, just to put it into context in the environment that we are in, where cost of labor, cost of raw materials, as well as cost of finished goods as a result has gone up in many cases by 30 to 40%. If you think about gross profit margin expanding, you will understand the quality of such companies, because these are businesses that have the ability to translate many of their finished good products into the end consumer, be it a B2B or a B2C, as a result of which many of them managing their inventories well means this translates into cash flow growth. And as a result of which they are able to expand their market share during a difficult time. There are other kinds of companies which are growing their revenues at the cost of margins, at the cost of gross profit margins as well, at the cost of a slightly deteriorated balance sheet. We want to be cautious on such companies. And if you look at the portfolio at the overall market cap basis, it does look like our average market cap looks like a mid-ish cap portfolio. It's around 48,000 crores, but we have a fair mix between large, mid, and small today. Right? And the last aspect, which very few people talk about, is you would not want to sacrifice liquidity at all in our portfolio. And we continuously measure that around how quickly it is to liquidate our positions. And what kind of liquidity are we sacrificing if we go down the market cap curve in terms of investment? And that's been a premise of importance for us since starting the fund. Now, basically, just to zoom back in today, right, into the portfolio, I started off by basically giving you my perspective and our view on the US. How do we see the same thing in India? The two economies seem to be diverging from a fundamental perspective and a liquidity perspective. I am continue to be bearish in the US. I continue to be optimistic in India. What does that mean? Effectively saying that any volatility that you see is a buying opportunity. I still don't think that you can just go and buy aggressively in the market just because the market is down 10%. I still think there is risk in the system from a liquidity perspective that will translate into volatility on the micro, and that's what we would want to use in order to add capital back into the market. So that's how we think about risk from a holistic perspective. Now, coming back into the portfolio around what we are doing, Broadly, from a top-down perspective, we are invested across 7 themes. 7 themes being there is lending financials, there is non-lending financials. Non-lending financials are effectively companies which do not have leverage on their books, right? So it could be an insurance company. We used to own AMCs. Today we have zero risk in AMCs. Auto ancillaries, which is manufacturing companies, B2B manufacturing companies, especially in the chemicals or specialty chemicals business, pharma, IT services, and consumer brands. Again, the common theme in our portfolio is to own those companies which are gaining market share and growing their margins. Because end of the day, if the inflationary theme is here to stay, you want businesses which have pricing power and at the same time who don't lose market share around pricing power. It's no point of raising prices and losing market share. Those are again not fundamentally strong companies. And lastly, this is something that we have been underweight for a good part of 1 year. While financials today look like they are cheap, we continue to study them around saying do they deserve more of an exposure in our portfolio, but we continue to be underweight financials because we feel that there are better pockets of ownership of investment, and at the same time capex across sectors is still not flowing through. Capex is flowing through in specific sectors and specific parts of the supply chain. So end of the day, to structurally own banks doesn't add too much of value as far as we are concerned. Final thoughts before winding up the presentation from our side. We continue to believe the portfolio health is at its best shape, though the first half has seen drawdowns. Higher inflationary regime has benefited our portfolio. Why do I say that? Because you have companies today who have grown their earnings, grown their market share at higher prices. So if inflation does normalize itself, which I'm not saying when it will, but when it does, you will see these margins accrue back to these kind of companies. India continues to be the best region for risk for deploying capital, and risk continues to emanate from the US. And I don't think that the risk in the US is done, and people who basically say they're calling for a bottom, I'm not sure how you can call for a bottom. You might get bear market rallies. That's par for the course in the markets, but end of the day, we would want to be using those sell-offs in order to increase our exposure of equities in the overall portfolio that we construct.